let's talk about bonds. As all of you know, anyone here who has bonds in their portfolio, which is almost everyone, bonds had the worst first quarter in the history of the United States of America. No exaggeration, no hyperbole, in the United States, the history. So they're bad. They were bad. As interest rates go up, bonds go down, right? Their valuations just got killed. So what I'm going to say is I'm going to show you this slide. I think it's a little much, quite frankly. I think it's tough to read and tough to look at. But I think that one of the big issues with bonds a couple of years ago, well, the beginning of the year, was as interest rates go up, or as they were there, the interest rates were basically at zero. So you had what's called like kind of what we call the Tina effect. Like there is no alternative. You didn't want to buy bonds at 0%, right? But you didn't want to buy the stock market at 20% overvalued. And what else was there, right? So we did a very aggressive rebalancing. We tried to do value stocks instead of growth. We tried to do short-term bonds instead of long. I mean, there was things that we tried to do, but you can only do so much in this market, where both the stock market at one point was down 25% and the bond market was down 13%. There's just kind of nowhere to hide, I think, in those environments. So now, though, that interest rates have gone up, yes, bonds have come down, but that's also shrunk that potential PE. You remember earlier I said 21 was actually not that far out of bounds. I knew it'd have to correct as interest rates went up, but the reason 21 was okay at the time was because as interest rates are low, the Tina effect comes in. You don't want to buy bonds, right? Unless you're just using them as a savings account, basically to either dollar cost average into or out of, or to rebalance into or out of, which is how we've been predominantly using them. But there was no alternative. You're not going to buy bonds at zero, so you just bought stock, right? Even though it was high. Well, now that interest rates are going up, the alternatives to the stock market look better, right? So they're not 0% anymore. Bonds are actually giving a pretty fair yield. And that's kind of what this is showing, is yields across the sectors are better. That also means that bond values are low. It's probably a good time to buy some bonds if you don't have any in your portfolio yet. But that is what is driving the shrink. Again, inflation, just a reversion to the mean, as well as the alternatives now. So there is no Tina effect. There is an alternative to the stock market, and it's not that bad, right? Because the bonds are now paying a lot more than they were before, and they're at a discount, so you can buy them for a little bit of a deal. So I think that's a big part of the reason that the stock market had to come down from 21 to 17. Again, we expected that, although it happened way faster than we thought. Luckily, it's mitigating a little bit more. The other thing I'm happy about bonds is well, before I go on, let me talk yields. The 10-year Treasury is what matters. What the Federal Reserve does on a day-to-day basis doesn't really much matter. It affects it a little bit, but the 10-year Treasury is really what to watch. The 10-year Treasury went from 1.3 at the beginning of the year to 3.5 in April. I mean, it's the highest. It's the biggest change it's ever made, which killed bonds, because as interest rates go up, the bond prices go down. What was the worst thing about that actually was bonds didn't act as a diversifier. So what this chart shows is if the blue lines go above that center horizontal line here, it means that bonds are not doing their job. And it means that as stocks either go up, bonds also go up, or as stocks go down, bonds also go down. So they are not acting as an anchor to the portfolio and as a diversifier to stocks. As you can see, going all the way back, this is a 22-year chart. Almost always is it down here, right? It's almost always a diversifier, which means as the stock market goes down, the bond market goes up. It did not act like that this time. So as the stock market was going down, you'd think, okay, well, we're protecting you in bonds. Well, in April 1st, bonds were down when we went to go rebalance, and bonds were down 10% and stocks were down 12%. So again, that's why there was just no place to hide, and there was no way that it was one of the smallest rebalances we've ever done, and there was just everything was down, right? Crypto's down, everything but your house, right? Gold was even down, which usually in inflationary environments they do well. Stocks, bonds, crypto, everything, right? Commodities did well. Commodities did okay, and energy did really well. But that was it. You're not gonna have your whole portfolio in something that was worth negative $36 a barrel oil, less than 2 years ago, or a little bit more than 2 years ago now. So what's nice is if you could see this little blip right here, right? In finance, we get excited about these little blips. This little blip right here, what that's showing is recently, right, the last handful of months, bonds have gone back to their typical role, which is they are a hedge against what the stock market's doing. They're a diversifier. Bonds have done better as interest rates went from 3.5 in April down to about 2.8. I didn't look today, 2.8, 2.9. You know, as those interest rates have come down, the bonds have come back up, plus they're earning interest every month. So they're starting to do their job again, which is why we are way more excited about bonds. Interest rates are higher, yields are higher, and prices are down. So as far as putting, you know, they're acting as a diversifier. So bonds today, I've been saying for 3 years, we did not like bonds. For the last 3 months, I've been saying we like bonds. So we are bringing them back in the portfolios in a big way, where we had tried to stay away from them in a lot of ways previously.